Hello, good morning and welcome to our lecture series. Today I'm planning to take about an auditing subject. It's all about a bank reconciliation statement. How to audit a bank reconciliation statement. That's what today I'm planning to take. Anyhow, first of all, we try to understand what is a bank reconciliation statement. We have to find out before we audit the bank reconciliation statement, we need to know exactly what is a bank reconciliation statement. A bank reconciliation statement is a reconciliation exercise. Now, suppose say now uh, now we let's say now this is our bank account. This is our bank account, and this has a debit and credit, and also we have bank statement that has deposits, withdrawals, and the balance. So this is the bank statement. Now, what I wanted to say is that when we look into the closing balance of a bank statement or bank account, let's say this is 100, and when we look into the closing balance of the bank statement, theoretically it must be 100, but 99.99% most of the time it will not be 100. It can be 200 or it can be 50. It can be any number which will not be same as this 100. So therefore, there's a difference between these two balances. Now, as an accountant, we have to reconcile and find out the reason why there is a difference. This exercise is known as a bank reconciliation statement. From every company, from the accounting department, as a matter of customary practice, every regular periods, maybe monthly, maybe weekly, maybe quarterly, maybe yearly, after this online accounting, maybe daily, online banking system, daily people or accounting staff could perform a bank reconciliation statement. That's not our objective actually. Today, I just wanted to talk through how we perform an auditing exercise, how to see the bank reconciliation statement, whether the bank reconciliation statement has been done in the right way. So, a reconciliation statement prepared by the company to evaluate the reasons for any differences between bank account as per the company books and the bank statement. This is what the bank reconciliation statement is. Now, what is an audit? If an organization does not perform a bank reconciliation statement, one big danger is that there is a high potential of frauds, high potentials of frauds, or there can be errors, which these both could lead to misinterpretation of financial statement. Misinterpretation of financial statement. So, as we have to express an opinion as an auditor, we have to express an opinion on the fairness of the financial statement. One of the main item in the statement of financial position is the bank balance. So, before we really express our opinion, we need to confirm such balances have been arrived in the right way. Since the bank balance are integrated with the bank statement or bank account, there are transactions that is happening through the bank account. Now, why a difference? Why a difference could come between the bank account and the books balance? I mean, in the company's bank ledger and the bank statement, possibly due to two reasons. One is the issues relating to the account or the business or the bookkeeper, or secondly, the issues related to the bank. Now, let us think about the issues relating or pertinent to our business, which are: we have issued a check to a supplier. The such check has not been presented to the bank. So we have issued that, we have recorded that, but that has not gone to the bank. So that is one thing. And the secondly, we have deposited check or cash to the bank. The bank has not recognized or realized this. These two are actually the issues pertinent to the bank. These two are actually the issues pertinent to the bank. And the third issue pertinent to the bank will be any possible errors taken place or occurred by the bank. So these are issues related to the bank. Conversely, what could be the issues relating to our business or our bookkeeper? Could be the bookkeeper also a human being. he could make a mistake. So therefore, there could be bookkeeping error. That is one thing. Secondly, uh, we could have given instruction to the bank whereby the bank are sending standing orders which we may not understood or recorded this. So this is the second issue. So that is known as standing order which has not been recorded in our books. Third, customers could directly deposit money, and these money could have been appeared in a bank statement which has not been recorded in our books. Likewise, so there are issues relating to bank, issues relating to our books. Okay, these all the accountant's job. Who has to prepare bank reconciliation? Now, what are the auditing objective of of us when we are auditing a bank reconciliation statement? The auditing objective could be, these are the auditing objectives. If you look into this, confirm that the balances shown in the financial statement are properly accounted. Now, we have to sign or we have to provide an opinion as to the balances in the statement of financial position. So, therefore, what we do is that we have to confirm these balances arrived in a fair manner. So, that is one reason why we have to perform an audit of bank reconciliation statement. Secondly, all transactions occurred via banks are recorded properly. So we are not missing, or the accountants have not missed any such transaction. Thirdly, no room for any unrecorded transaction. Now, if you really think about this, now in the bank statement there may be line items which the accountant could possibly missed or skipped or omitted, or sometimes deliberately he would have omitted something. So we need to make sure such omission or such unrecorded transactions are still exist. Thirdly, all bank reconciliation statements are timely prepared or reviewed and approved. Any cancellation of checks should be done properly. So what I mean cancellation of checks, when you have unpresented checks, sorry, when you have unpresented checks, these unpresented checks, if it lasts for more than 6 months, such checks must be cancelled. Otherwise, that also one part of the error that will prevail in the bank reconciliation statement. So therefore, these are the some of the objectives. Now, audit steps. So very first thing what we need to do is we have to find out whether is there any bank reconciliation statement prepared for a period prior to the period in which we are auditing. Suppose we are auditing for, let's say,